Welcome to Beyond the Bullion podcast.
Great to be diving in again.
Absolutely. You've been tracking gold and silver closely, and you flagged some really interesting videos from CPM Group, Silver Dragons, Bald Guy Money, all trying to make sense of these price moves.
Yeah, it's been quite a ride, especially for gold.
Exactly. So let's unpack this. You're probably wondering, why is gold hitting these new highs? And why does silver seem to be, well, lagging behind?
And what does it all mean, right? That's the key question.
That's our mission today. We want to cut through some of the noise, look at the key drivers the experts are pointing to, and just get a clearer picture of what might be next.
Sounds good. It really feels like two different stories playing out. Gold's surge is definitely the headline grabber right now.
For sure. CPM Group had gold pushing past $3,500, hit $3,509 briefly on Tuesday, April 22nd, before settling back a bit.
Right, settling around $3,420, I think they noted.
And what's really interesting, Silver Dragons pointed out this puts gold super close to its inflation-adjusted all-time high.
Yeah, the one from 1980, around $3,486 in today's money. That's getting close.
It really is. So what's driving this gold rush? Silver Dragons had some ideas.
They pointed towards maybe a breakdown in global trust and also significant central bank buying. That combination seems powerful.
Like major players hedging against instability.
Exactly. Plus, they mentioned the dollar being weaker, down about 10% this year, apparently, and the stock market looking a bit shaky. All potential tailwinds for gold.
It really brings back that classic safe haven narrative, doesn't it?
It does. But, Jeffrey Christian at CPM Group adds a note of caution. He reminds us these big jumps up, well, they can be followed by sharp drops, too.
Good point. You mentioned gold was around $3,000 just last August, wasn't it?
Yeah, so a $500 move up can sometimes mean a similar move down isn't out of the question, short term, anyway.
But crucially, he also said the underlying reasons, the economic worries, political tensions, social anxieties, those haven't disappeared.
If anything, CPM Group suggests they might have actually gotten worse. That's the core argument, I think. It's not just momentum. There are fundamental fears underpinning this.
And they noted something interesting, too. Usually in times like these, you might see the dollar and treasuries get a safety bid alongside gold.
Right, but this time it seems gold is the main beneficiary, which CPM Group suggests might show less confidence in U.S. government policies specifically.
Okay, that's a key distinction. Let's pivot to silver then,
Right.
because it's not quite the same story.
No, definitely not mirroring gold's run. CPM Group had it above $33 briefly, but trading more like $32.88.
And Silver Dragons highlighted that it hadn't even recovered from a dip after some tariff news came out.
So what's holding it back? The gold to silver ratio is a big part of the discussion.
Ah, yes, the ratio. Silver Dragons put it around 104.
Yeah, which is historically quite high. The average over the last 25 years is near 70, and even lower, like low 50s if you go back 50 years.
So for you listening, that high ratio often suggests silver might be, let's say, undervalued compared to gold based on history.
Potentially, yes. CPM Group offered some more concrete reasons for the lag. They talked about the New York silver market being well supplied.
Okay.
And apparently the price difference between New York and London isn't big enough right now to cover the costs and logistics of shipping silver back to London.
Interesting. So physical market dynamics at play.
That and also weaker demand. They pointed to lower industrial use, less demand for jewelry, even silverware, all tied to broader economic concerns.
Those are definite headwinds. So does anyone expect silver to catch up?
Well, both Silver Dragons and CPM Group seem to think silver prices will rise further eventually. But CPM Group thinks it'll be a tougher slog for silver compared to gold. More hurdles to overcome.
Okay, but then we heard from Stefan Gleason on Bald Guy Money, and he had a more, let's say, bullish take on silver specifically.
Yeah, he framed it as potentially a vastly better investment opportunity than gold, looking at risk versus reward.
Especially if your time frame isn't just the next few weeks, right?
Sure.
He expects silver to outperform later in the cycle.
Exactly. And he really leaned into that high gold to silver ratio. His argument, and it's a historical one, is that when the ratio gets this stretched,
Silver tends to snap back hard eventually.
it often has, yeah, delivering stronger returns as that ratio corrects. So for you, this current underperformance might actually be seen as a signal.
A signal that the bull market isn't over and silver's big move is maybe still to come.
Potentially setting the stage for silver to play catch-up and maybe even lead later on. That's the thesis.
Bald Guy Money also put the recent pullback in context, didn't they? noting that lots of assets were selling off.
Right, but gold held up relatively well, staying above $3,000, especially compared to the S&P 500 and Nasdaq, which have had a tougher year to date.
That resilience is notable. They also kind of revised their timeline for silver's next leg up, suggesting gold's recent reversal might delay things slightly.
Shows how interconnected things are. And for you thinking about potential downsides, Bald Guy Money did offer some specific ranges for a pullback.
Based on historical patterns after the fund's first rate cut, I think.
Correct. For gold, they suggested maybe $2,750 to $2,800. For silver, a wider range, $23.20 up to maybe $28.17.
Important to remember, those are just potential scenarios based on past behavior, not predictions.
Absolutely. But even with those possibilities, Bald Guy Money seemed pretty bullish on precious metals heading into 2025.
Why is that? What were their reasons?
They pointed to expected interest rate cuts, multiple cuts, potentially, and also the idea that Paris could push countries to diversify away from the dollar. Both could be positive for metals.
And they brought up the ratio again.
Yeah, reinforcing that idea that a high ratio could signal a bottom is near, potentially followed by a major run-up, with silver possibly outperforming gold in that phase.
Okay, let's shift gears slightly to the central banks. CPM Group had some data on their buying activity.
Right. They noted that overall, central banks bought about 40% less gold in 2024 compared to 2023.
And the start of this year was slower too.
Yeah, lower buying in the first couple of months. But there are nuances.
Like specific countries.
CPM Group mentioned Russia, for example, being both a buyer and a seller, using gold reserves to manage finances and fund the conflict in Ukraine.
Okay.
And they also said some other central banks seem to have pulled back a bit simply because prices got so high. Still net buyers overall, perhaps, but more price sensitive.
So even the big institutions are reacting to these price levels. That makes sense.
Seems so. Investors, too, not just central banks, have apparently eased off buying quite as much gold at these elevated prices, according to CPM.
And a couple of other quick macro points from CPM Group. The U.S. dollar weakened from its March 2025 high.
Yes, it had fallen back, and Treasury bond prices had also declined. These things are often linked to precious metal movements.
They're definitely factors to watch. Did they mention how investors might be handling this volatility? Hedging, maybe?
They did. CPM Group mentioned they'd been helping some clients buy put options on gold.
Sort of like insurance against a potential drop.
Exactly. It's a way to hedge your long gold position if you're worried about a short-term pullback but still want to hold the metal. Gives you the right to sell at a set price.
Useful strategy for some. Okay, finally, inflation. Always a key piece of the puzzle. What did CPM Group say about the latest data?
They looked at the recent CPI numbers. There was a one-month dip, a slight contraction.
Oh, what drove that?
Mainly falling oil prices. But, and this is the important part, they stress that looking year over year.
Inflation's still high.
Yeah, still above the Fed's target. And things like food prices are still climbing.
So, despite maybe a temporary dip in the headline number, the underlying inflationary pressures are still very much present.
That seems to be the takeaway. And that persistent inflation, that economic uncertainty, well, that often supports the case for holding precious metals as a store of value, doesn't it?
It certainly does. So, wrapping this up, it's clear gold has been on a tear, driven by, well, a cocktail of global worries and central bank moves.
While silver's path seems a bit more complicated right now, influenced more by industrial demand and specific market factors.
The experts we looked at, they offer slightly different takes on pullbacks and future potential, but that common thread is their economic and political instability really fueling interest in metals.
And that idea about the gold to silver ratio, that high number, possibly signaling an opportunity in silver, that's definitely something for you to mull over.
It is. This deep dive just gives you a snapshot of a really dynamic market. We definitely encourage you to think about your own goals, your own risk tolerance as you process all this.
Yeah, what stands out most to you from what we discussed? What questions does this raise for your own investment strategy? Those are the important things to consider.
Thank you for joining us for this deep dive into the precious metals markets.
Always a pleasure.
And thank At Cost Metals, LLC, for being a sponsor.